Hello, everyone. Today on the Final Bar, I'm joined by Mary Ellen McGonagle. Should be familiar to many of you. She does a great job on a number of shows here on StockCharts TV. I think of Mary Ellen as one of my favorite stock pickers. She always brings a couple tickers that make me think, point me in the right direction, and I don't think you'll be disappointed today. Today, the S&P selling off, the NASDAQ leading the way lower, a bit of a recovery, cutting half of the loss here into the end of the session. What does this mean for the big picture? Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the message of the markets themselves. We focus on indications of price and breadth and sentiment and trend and momentum, all the tools of the technical toolkit to help us understand investor psychology. And this week has no shortage of potential catalysts. Earlier today, we were recording our latest episode of The Pitch. It was a lot of fun, a really good discussion. We talked about just this particular week. It's an interesting time to be, talking about the overall market environment. We have the Fed, meeting today and tomorrow. The Fed, meeting resolving tomorrow. We'll get some sort of color from that. We have a ton of earnings, about 30 to 40% of the S&P members reporting earnings this week, including today, as we're recording this show. Small companies you may be familiar with, like Apple and Microsoft and Alphabet, Visa and others, unleashing their earnings into the world. So we're going to look at as much as we can here in 30 minutes, try to point you in the right direction, and also answering your questions from the Final Bar mailbag. So a lot to come. Before we get that, I just want to mention coming up on this show today, we have Mary Ellen McGonagle joining us, I think, for the first time, but is a frequent guest host and speaker on StockCharts TV. Tomorrow on Wednesday, the 28th, we have Cliff Droke from the Cabot Wealth Network. On Thursday, technical analyst Bruce Powers joining the show. Once again, next week, coming up on August 3rd, we have Andrew Thrasher from Thrasher Analytics. And then on Thursday, the 5th, Mark Chaikin is going to be joining the show. So we have a lot of fantastic guests. Super excited for a lot of these conversations. Again, I mean, the benefit, hopefully for you, is it's not just me trying to help make sense of things. We're bringing in some pretty talented investors to help you with the thinking as well. Continuing on with our market recap today. So as I mentioned, there's a distribution in the morning, accumulation of a bit sort of in the afternoon, with the S&P cutting about half of its loss. Potential loss from earlier in the day. The S&P closing just above 4,400. That's about 0.5% below yesterday. The NASDAQ, though, really leading the way lower from the major averages, with the NASDAQ 100 down 1.1%. Mid caps and small caps underperforming the S&P, which has become overall sort of the norm for this recent environment, but not always. We've seen some bounces from small caps. Not today. Continuing on, we have the other asset classes, bond markets, appreciating today with a TLT up about 1%. 10-year yields down from 123, which is down from yesterday. It was about 127, 128. Commodities, gold was one of the few commodities up. Overall, commodities were weaker, with energy stocks going lower, oil prices going lower as well. Cryptocurrencies ended up being a pretty choppy session. Yesterday was a big move, obviously, in cryptos after the weekend, which was incredibly volatile as well, but overall pushing to the upside. Bitcoin has broken above 40,000, only to come down, and it's settled in around 38,000 right now. Let's look at a chart of the S&P 500. So, it's interesting. We have this day today where we're closing below the open. It feels like the biggest bear market in history because it's so rare we have down days anymore. And the good news is bear markets only last about a day or two in this environment from my recent experience. And I'm saying all of that with a great dose of sarcasm. Overall, we're getting a bit of a pullback here today, bouncing into the close, but it's reasonable to expect a good amount of choppiness here with all of the potential inputs. At the end of the day, the S&P sort of nets out. It's the aggregate of what the market is saying, but remember, the market is comprised of a lot of different things. There are a lot of different themes that investors may be acting on or reacting to on any given moment, and this week especially, the next couple of days where we have a lot of big companies reporting, a lot of potential with mega cap stocks surprising to the upside or the downside with the opportunity to move the markets very quickly. So a lot of things to digest. As always, I'd encourage you in this environment to take a step back, focus on the big picture. When you take a step back on the S&P, we see a market that continues to make higher highs. And again, the most bullish thing the market can do is go up. That's what Paul Montgomery, who's a legendary technical analyst, used to say. And it's true, right? We continue to make higher highs. We've made higher highs again this week. As long as that continues, things are not that bad, regardless of what warning signs you may see. If we do see any further distribution, and again, my concern with this current environment is the weakening breadth characteristics, right? The weakening breadth, which we've talked about many times in the last 3 to 6 months. How many times have we seen the breadth and not quite confirm the uptrend, only to eventually resolve and confirm the latest highs? We've not seen that yet, June into July, so we're back to that familiar pattern of the breadth measures continue to be negative, of the market making new highs so far on lower momentum, which is a pattern we saw. I've indicated them a couple here in April and again in January. Now, each one of those, if you do get a bit more of a pullback going through the course of this week, and it would confirm a bearish divergence of higher highs in price, lower peaks in momentum. Each one of those last couple times has seen the RSI come down to around 40, which is pretty classic in a bull market phase. We've seen a pullback of around 4 to 5%, which has become sort of the normal, plain vanilla, basic pullback during the course of the last 6 months, really year to date, starting in January. So we'll have to see if that pattern that we've seen a couple times continues. And once a quarter, we get this 4 to 5% pullback after a bearish divergence. Who knows if that is what will come. Based on what I'm seeing, I would not be surprised to see that sort of move. First things first, let's focus on the 50-day moving average and see if that's able to hold or not. A bit of a different feel in some ways to the market today, because you saw once again defensive leadership. Remember, there was that time not too long ago where it was either sort of the value stuff, the cyclicals, or the growth stuff was working, right? It's tech and communications at the top, or it's financials and energy and materials, right? And it was sort of flip-flopping which of those two would be leading the market higher. What we've seen recently are some of these risk-off days, and that's one of the days we saw, in the last week, we saw a bit of distribution led by with the defensive sectors, really indicating less of a growth versus value, but more of a risk on versus risk off. And that's a bit what today sort of felt like. Utilities actually up 1.7% today, real estate up 0.8%, followed by healthcare. Most other things were flat to down, with communication services, consumer discretionary, energy, technology sort of leading the way lower. So overall, you get a bit of a defensive move today. You can see a bit of a risk-off play going into, again, all these earnings coming out. And as we go through the course of the show, we might check on some of the earnings and some of the after-hours trading on, especially some of those mega cap stocks that I'm certain we'll be wanting to pay attention to. In terms of industry groups, we haven't looked at this recently. I was looking at some of the previous shows, and I noticed how much we looked at some of the industry returns. Let's look briefly there, and then we'll look at some of the other charts before we take a break here. It's interesting to note, we saw the strength in utilities. 4 of the top 10 industry groups, we have about 106 industry groups that we track. 4 out of the top 10 were in the utilities sector. Very rare that has been the case. There are not many days during the year 2021 where I probably could have said that. Worth noting that mining stocks and gold miners were actually on the high list as well. Let's look at Newmont Mining. I've not looked at this chart. That's not the ticker. I've not looked at this chart yet today. NEM, a bit of a bounce, right? And the challenge with some of these gold stocks is they're coming off of a bit of a pullback level. Newmont Mining up 1.5% today, which on a day when the averages are down is going to be pretty decent. This is coming off of a fairly beaten down level. It's interesting. I mentioned doing the pitch earlier. Greg Schnell was one of the guests, and he talked about materials and energy and had a couple picks. Newmont Mining and gold stocks were not one of those, one of his 5 picks. But it's interesting, while you're seeing a bearish divergence potentially on the S&P 500. You're seeing a bit of a potential bullish divergence here on the chart of Newmont Mining, right? You have the low in June bouncing off the 200-day. We've broken below the 200-day, bouncing off of sort of the 60, 50, 59 to 60 level, bouncing a little bit here. You can see the higher lows in momentum as the price is going lower. So as we're nearing sort of this consolidation, right, this area of support down here in the 55 to 58 range, we're sort of nearing there, and we have a bit of a bullish divergence. It'd be interesting to see if we find a bounce there. In general, those are not the types of charts I tend to promote too often. I'd much rather find things that are in uptrends that are finding higher lows. So for me, that would be the one I would certainly want to be looking for on a chart like NEM, is making some sort of higher low. On the downside, delivery services, and that would make me think something like UPS, FedEx would be the names to do it. Yeah, that's certainly going to do it. So, as I mentioned, we have a lot of earnings. I haven't really processed where UPS falls in the distribution of those, but overall, you can see a concerning lower high on the chart of UPS, and now really testing that low. What's interesting about what happened today is you traded well below the June low, down to around 190. We've closed back right to that breakdown level, and so we're right at support basically. And so the question I would see for tomorrow and continuing on through the rest of the week: does a stock like this find support at 195? Does it establish a low close and sort of bounce above there? Do you see additional demand at the previous support level, or does that support level fail? And if so, I would say you have to look down to the 200-day moving average on 180, which is around that breakout level. This was a key breakout. If you remember this chart, there's a 6-month basing pattern, 6-month plus. We gapped above there, and UPS really hasn't looked back too much. Now, all of a sudden, rotating back lower, and that would be a level I may want to key in on if we see further distribution here. We need to take a quick break. We'll be back with my guest, Mary Ellen McGonagle. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Thank you so much for joining me every weekday after the close for our show. A couple quick announcements before we get to my guest, Mary Ellen McGonagle. First off, if you have questions for us, particularly questions using stock charts, questions about technical indicators, about market sentiment, investor psychology, whatever it is, nothing is out of bounds, and we would love to hear from you and answer, hopefully, one of your questions in our next mailbag segment. We'll be doing another one a little later in today's show, and one more on Friday of this week. You can get your questions to us 3 ways: via email, thefinalbar@stockcharts.com, on Twitter @finalbarsctv, on our YouTube channel. Just put a comment below the episode that you're watching. We'll gather all of those questions, and we'll hope to answer one of your questions in our next mailbag segment. Also, as a reminder, go to stockchartstv.com, use your email account, set up a free use your email address, set up a free account. You can start watching all of our fantastic content, shows like Chartwise Women and others, great guests like Mary Ellen McGonagle, and a lot of fantastic special events like The Pitch and others. Go to stockchartstv.com. You can also search on your mobile device on any of the app stores for Stock Charts TV on demand. I want to welcome on today's guest, Mary Ellen McGonagle, hopefully a name very familiar to many of you. Mary Ellen's done so much on Stock Charts TV, hosting her own show, as well as hosting Chartwise Women with Aaron Swenlin. Also the founder of MEM Investments, coming to us from California. Mary Ellen, welcome to the show.
Great, thank you. Good to be here. We picked a good day, right? Oh my word!
I'm glad you think that. It's always fascinating, I mean, and again, this is real life. This is what happens. You have a lot of movement, a lot of volatility, a lot of unknowns. But at the end of the day, we have to put a portfolio together of stocks. We have to place bets. So I appreciate you sharing what you're seeing recently with us. You brought 2 stocks with us. We're starting with Chipotle, a stock that's seen a bit of a bounce recently. Talk us through this one.
Yeah, so the 2 charts I chose are all about earnings. Most of my work centers around identifying stocks with high growth, both earnings and sales. Those are proven to be the primary driver for these big winning stocks that go on to far outpace the market. So with that in mind, we're looking at Chipotle. They did come out and report earnings last week, and that is that big gap up that you saw. So what I wanted to share with you was a strategy that I used in getting into this stock upon keeping an eye on the markets after the close. And of course, today will be very instrumental. Microsoft already came out with their numbers, but what I noted was that Chipotle had explosive earnings growth well above anything analysts even thought. And the stock was up after hours. Also took a good look at the futures, and the markets were poised to trade higher the following day. So I did put a trade in so that on the open, I would get that first tick, and have since participated in this upward move here. Now, of course, you are going to, again, take market backdrop into consideration, also what industry group it's a part of. And there were other names. Domino's, DPZ was another restaurant stock, really came in ahead of earnings. So those are the kind of considerations if you are considering this kind of trade. You do want to be careful, because we did just look at UPS. There has been really dramatic distribution if companies disappoint as well. So that was one way that you can capitalize potentially on this period, this earnings period. But I also wanted to show historical precedent as far as stocks that have reported super strong earnings. In fact, before we leave Chipotle, I did want to point out to you the fact that the RSI, upon that gap up, or prior to it, had dropped below that overbought position. That was another consideration for me before considering if it were in that overbought, I would not be as enticed. And also the MACD had pulled back a little as well. It was not in as high a position. Currently it is super high. I did take half of my position off, just a nice 10% move in a few days. But let's go ahead and take a look at Edwards Lifescience. And this is the other chart that I wanted to share with you when you're looking at potentially entering into these stocks after they release explosive earnings. So they are due to report their second quarter coming up, but this is taking a look at their first quarter earnings. They reported in April, and you can see the stock had a very explosive move in response. But if you take a look at the RSI position and the MACD, they are both in overbought. This is something I brought to the attention of my MEM Edge report subscribers, noting the high earnings growth. However, I put the stock on the my watch list with an eye toward a pullback and getting into the stock upon the reversal of that pullback. So we kept this on our watch list, waited for those RSI, those momentum indicators, to pull in away from those overbought areas, and a nice orderly pullback to that 50-day simple moving average. And then the stock was put on to my MEM Edge report in that dashed line period when it broke back above those simple moving averages, and then your momentum indicators turned positive. The stock is still on our suggested holdings list for MEM Edge report, and we're up over 22%. So two different ways that you can play, if you will, these stocks. We're seeing most companies, over 85%, are coming in not just above estimates, but well above estimates, and very encouraging that the markets are by and large rewarding those stocks.
These are two fantastic examples, Mariellen. I appreciate you so much talking about the relationship between the charts and earnings. I think a lot of investors kind of hesitate when earnings come out, and I think you've shown how to think about the charts, very intentionally when around earnings season. We only have about 30 seconds left, but I'd love to just ask you, obviously, with a number of the FAANG stocks reporting today, Alphabet and Microsoft and Apple and others this week, when you're looking at the market going forward right now, do you see opportunity in a space like that, which has had pretty good runs, but arguably overextended in some ways, charts like Facebook and Alphabet, which have already had good runs? Is that a place that you would sort of ride out this uncertainty, or are those the types of names that you would hesitate to, given the runs that they've had already?
Yeah, those same dynamics are going to be really critical at this juncture. You're going to want to pay attention to those momentum indicators on their daily charts to get started as a way to make a decision, because they have had these big runs into earnings, unlike their prior quarterly periods. So you look at a Google, they're pretty much all up there in overbought position. But I would say Google's MACD, it still looks to have further upside. So when you are paying attention to these earnings and how they respond, keep your eye on those momentum dynamics to help guide you.
Mary Ellen, listen, it's a pleasure to reconnect with you as always. I really appreciate you sharing your thoughts here. And I should point out to everyone as they're hearing you describe this, I am very thankful when I first reached out to you, when we both started getting involved in StockCharts. I remember very fondly meeting you for lunch. You were generous with your time and talking to me about what your experiences had been. You continue to be generous with your time and your expertise, and thank you for that.
Of course. Thanks.
That's Mary Ellen McGonagle. Mary's the founder of MEM Investments, coming to us from California. And what I love about her discussion, if you look at those examples we talked about, Edwards Life Sciences, healthcare, certainly have been a number of great moves. Chipotle's had such a great bounce here in the last week. But I love that relationship. It reminds me of conversations with Tom Bowley of thinking about the relationship between earnings and price, and focusing on how the market is anticipating earnings leading up to announcement, how the market reacts afterwards, and agree that that the charts are such a beautiful way of understanding how investors are anticipating potential changes in the company's prospects, and also how they digest earnings like we've seen. Great lessons for a heavy earnings week. Let's continue on, opening the final bar mailbag. As I've mentioned many times, I love the interactive nature of the show. Love to hear from you. As a reminder, best way to get your questions to us is via email, thefinalbar@stockcharts.com. Send us any and all questions that come up. We have a couple to share with you right now. First off, the McClellan Oscillator is negative while the market is making new highs. How is that possible? Decent question. Actually, I brought this up ahead of time. Here we go, the McClellan Oscillator. So this is the McClellan Oscillator, which is $NYMO. And on the bottom, we have the S&P 500. And what you're noting is the S&P is going higher, but the trend in the McClellan Oscillator, and I have a 50-day moving average of the daily values. You can see it's been clearly trending downwards. You can see lower highs, lower lows. It's been below zero, by the way, since mid-June. What does that mean? So you have to remember how the McClellan Oscillator is calculated. And if you don't know, go to the Chart School article that describes the McClellan Oscillator. It does a really good job of explaining what Sherman McClellan and his wife, whose name escapes me, I'm sorry, Sherman, but Sherman and his wife had actually created this McClellan Oscillator, and Tom McClellan, their son, has done a great job continuing to promote its analysis of breadth. It's based on advanced decliners. And it's exponential moving averages of the advanced decline line. And if you look at the advanced decline line, especially on the New York Stock Exchange, you can see it's been sloping downwards as well. And what it speaks to is just the narrow leadership conditions that we've had, right? It's been, a lot of the cyclical sectors, the financials and energy and materials and industrials have all rotated lower. There's still only 50 to 60%, I think, of the S&P members above their 50-day moving average. That's relatively weak breadth compared to previously in April, when you saw most things going to new highs and above their moving averages. So I think that just speaks to the conditions. It can happen if the advanced decline line is sloping downwards, and that's basically what's been happening. The chart we usually use, by the way, to look at advanced decliners is on the Mindful Investor Live chart list. It's this one, the third chart in the packet that does the S&P close, and then it has the cumulative advanced decline lines for the different asset class. It's basically McClellan Oscillator is basically driven off of that top on the NYSE advanced decline line, which, as you can see, has also been sloping downwards over the last 6 to 8 weeks. That's why the McClellan Oscillator is going down. Question number 2, does it make sense to look back 6 months, 1 year, or even 5 years to compare relative performance to the S&P 500 for long-term positions? Or should I be looking back 10 days to see recent performance or since the last low? Also, how do fund managers set performance goals? That could be a very long-winded answer, but the short answer is as such. Does it make sense to look back 6 months, 1 year, 5 years, 10 days? So the answer is not one answer. It really depends on you and your investment horizon, right? The question you should first be asking, I would argue, is what's that time frame that you're trying to operate? Are you trying to trade for the next couple days, next couple weeks, which I consider the short term? Are you trading more for the intermediate term, which is 6 months to a year or two? Or are you investing long term for like a retirement account 5+ years down the road? And I think the way you answer that question will impact the way that I would suggest you look at charts and technical indicators, particularly relative strength. If you think about Julius de Kempener's work with the RRG, he has a daily version, which is really looking at the last couple months, I would say, the last couple weeks to a couple months. It's sort of that short-term time frame. The weekly RRG is looking a little longer term. And so I think, I'm more of a longer-term investor. I'm trying to think more 3, 6, 12 months down the road in general. And so as a result, I use the weekly RRG. I look at 2-year daily charts and 5-year weekly charts. I really 7-year weekly charts most often as a way to make sense of it. And so when I'm looking at relative strength, I'm really focusing at the last 6 to 12 months. Most of the academic work, by the way, that's been done on relative strength focuses on the last 6 to 12 months as being a good indication of future outperformance. Things that do well on that trend, on that time frame, tend to continue to do well. That is the sweet spot for trend following and stock picking. How do fund managers set performance goals? I'll just briefly answer. It really depends. There's so many different ways you manage fund, and it's hard to really, if you think of fund manager at a traditional mutual fund company, it would be all based on a benchmark. You are paid and you're evaluated based on your ability to outperform a benchmark. So absolute returns are relatively meaningless. You're not trying to go up on an absolute basis, although that's always great. You're trying to go more, you're trying to be outperforming your benchmark index, and that's called alpha. Beta is sort of the market exposure. Alpha is your ability to outperform. That's the benefit supposedly of active management. And you are evaluated and you are literally paid on your ability to outperform. The more percentage points that you outperform on a trailing basis, the better you're going to do. So that is really the goal. And there's a lot of detail that goes behind everything I just said, but that's the basic way you think about it. Final question, then we have to wrap the show. Chaikin Money Flow telling 2 different stories based on period and timeframes. Can you take a deep dive into Chaikin Money Flow? I can't take too deep of a dive in a minute, but I'm going to do my best with these 2 charts that you sent me. This is with EPD, and you have a weekly chart, and the Chaikin Money Flow is here in red and green. Chart number 2 is that's the daily chart that you're showing me there. The weekly chart is number 2, and you can see it's very positive. So the Chaikin Money Flow is very positive on the weekly chart, but actually very mixed on the daily chart. Here's the reason why. Chaikin Money Flow is basically an improvement on advancing declining volume. So it looks at one of the standard ways to measure volume is look at the daily volume read. There's this thing called on balance volume, which Joe Granville invented and popularized, which took the entire day's volume and considered it positive or negative. Mark Chaikin improved on that model and did what's called Chaikin Money Flow, which actually looks at where you close versus the high and the low for a period of time, and then attributes the volume based on where we're at relative to that range. So the reason is when you're looking at a weekly chart, you're looking at the entire week and thinking of its entire volume based on where you close the week versus the entire week's range. On the daily chart, you're doing it on once a day. So the daily charts are going to be a lot more sensitive to the short-term fluctuations. When you have this choppy period, you're going to get a lot more mixed signals, which is why as a longer-term investor, the weekly money flow certainly should be a better indication of the directional volume over a longer period of time. For more color on that, certainly go to the Chart School article on Chaikin Money Flow. We have to wrap the show though, and go to the 3 and 3 charts in 3 minutes. Here we go. Chart number 1 is the FAANG Plus Index, what I call the FAANG stock. This index or FAANG chart of this group of stocks, the FAANG Plus Index has been coming off. You can see the relative strength has been underwhelming so far in July. 3 of these stocks, actually 4 of them are reporting this week. If you include Facebook, which is Wednesday after the close. I think this is an important space to watch. I've asked everyone, and I even asked Mary Ellen today, what they think of these FAANG stocks. I personally see them as fairly extended. I think they're a decent safe haven to be, but I think you could see a situation where they come off in price, but still outperform because people are going to flock to some period of safety given the market uncertainty. It'll be interesting to see how they react relative to earnings, because that has the chance to move the markets in a very big way. Chart number 2 is the McClellan Summation Index. I had a question about the McClellan Oscillator. The McClellan Summation Index basically takes the daily McClellan Oscillator read and turns it into a continuous series. You can see this has been trending downwards, similar to the decline in the cumulative advanced decline line. That's a concerning sign for the market right now. A break below 0 would be very negative, by the way. It hasn't been like that since the March 2020 sell-off. Finally, PayPal. This is a stock that is testing all-time highs. We did the pitch earlier today. We recorded that latest episode. All three of my guests picked a payment processor, and PayPal was one of those. I encourage you to watch that for the full take. But overall, I think this is an important chart to watch. Can it eclipse previous highs at 310? Ladies and gentlemen, that is our show for today. Thank you so much for joining us every weekday for the Final Bar. Thank you to Mary Ellen McGonagle joining us from California and sharing her thoughts on the current market. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.